Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. Okay, so we are live here with a good friend of mine, Ryan Else. I've known him for a handful of years. It's been a couple months to almost a year since we met, Ryan, but we keep in touch. We text each other, and I always like to just, get guests back on the show. Ryan was on the show a couple of years ago. Ryan was in our fund accelerator a little while back, and just excited with what he's doing. We've shared a lot of notes on our mandates. We've both invested in deep tech and high-speed computing and software. So there's always just been interest in parallel in terms of investing, and we've also been in the same place in life. We're both parents, so we've shared a lot of stories, war stories about being parents. So I think that's kind of an interesting place when you can kind of be in the same journey with other people and have things to talk about. But anyways, Ryan, welcome back to the show. Thanks for making time for me and the community. I know you're super busy, so you making time for me means a lot.
Hey, I'm glad to be here. It's great to have you along this journey with me. As Joel said, we've been friends for a while. We both have kids that are similar ages. In fact, when my wife was pregnant with our very first kid, I was in New York on a trip and found out, and I was so giddy about it. Joel was the very first guy I told, and so it was a special moment for he and I, maybe for me more so, I don't know, but
it was for me too.
Joel wrote a book. If anyone knows, Joel has a book that's a kid's book, and you can buy it on Amazon. That's a shameless plug coming from a fan.
Thank you.
We gave that to our son, and he really enjoyed reading that. I had a fun time reading it too. But
thank you so much. So an update on that. I just want to give you guys an update. My son has a talent show today. So I'm going to actually just give a shameless plug because we're all plugging here. Why not? And we're live. So my son has a talent show today, and I was like, hey man, you should write a book. And, he came up with this book about these two snow leopards, and, they're building a tree house. So what we did was we just kind of came up with the cover. This is like entrepreneurship 101, right? So we came up with a cover image, and there's a barcode, and the barcode, you can actually pre-buy the book. And I was like, hey man, if we get a sale, we can use that to, market the book. But he's going to be doing a reading. And then I printed out, here it is right here, actually. This is called Jude's book. This is Jude's book. I actually can't see it anyways, but I'll send it later. But anyways, it's cool because he's he's kind of learning entrepreneurship and, the concept of marketing and pitching and stuff like that. So I'm really excited about that. I think, if you have kids, teaching them entrepreneurship, because when I was a kid, when I grew up, I just learned about, math and science and, hey, put your head down and get a job. And then I think it's really as you meet other people in the community and you see what they're doing, you realize, hey, you know what, people can go out and launch a business. People can go out and launch a fund. And, the whole spirit of the Sutton Capital Accelerator is really being a capital entrepreneur, right? So yeah. Ryan, maybe you can just give a quick overview on, we sent the bio, but just kind of a quick overview on your career and kind of where you are with Roadster Capital. And obviously no fundraising, no updates on fund, little updates or anything like that.
General solicitation.
No general solicitation or anything, but just trends on the fund and trends in the sector. And then we'll cover, and then we're actually going to have Ryan do a little academic module on fund modeling, just best practices for modeling a fund. And again, just for purposes of this presentation, all of this information is for educational purposes only. There's no purchasing or selling securities on the call. So just want to give that disclaimer to make sure that everyone knows it's for knowledge and learning purposes only.
Yeah, thank you for making that clear for everybody. Anything that I show everyone will just be examples. They're not direct reflections of our particular fund or our exact structure. It's just going to be a broad scope of ways to think about it when you're thinking about fund construction and all of the facets that are associated with it. So my name's Ryan Ellis, as Joel said. I'm the founder, managing partner of Roadster Capital. Roadster is a pre-seed, seed stage VC fund that invests in companies that are solving challenges around automation, trust, and sustainability for the American industrial base. And we really want to propel old line physical industries and help digitize them with things that we think are critical to achieving the next great milestones and advances in business with a real core look at science and technology and real hard facts. So so our fund as a whole is doing well. We have a lot of really strong interest from LPs. We have a good LP community, and we continue to build that and build relationships with LPs as well as with founders. We think they're on similar levels to us, although at the end of the day, our true first customer is always going to be the LP, because we're going to be investing as a fiduciary on their behalf into these founding teams. And my background, I have an MBA in finance from University of Notre Dame. I started my career very early on at Oracle in different sales and marketing roles, and throughout my career worked at different startups and Fortune 500 companies. Eventually led me to leading a global turnaround, spending my time in Hong Kong and North America a lot on the manufacturing and factory side in electronics. And then I started making some investments through special purpose vehicles with Roadster Capital, and eventually formed a thesis around that led to where I'm at today. And it's been a really great journey. Like many will tell you, not every journey is the same. We all end up in life at different places at different points in time. And I really don't think there is a real proper progression into any role at any company or becoming a VC. You're going to find people with a myriad of backgrounds, from creators to entrepreneurs to people who are just math whizzes that end up in these different type of roles. And with that comes a number of nuances and a number of different personalities. And I guess, Joel, the proper way to say it would be a number of archetypes that are associated with both VCs as well as with the LPs that we reach out and speak to as either high net wealth individuals or institutions, foundations, family offices, and the like. So it's a real true mixed bag that I believe is driven solely by relationships as the core founding principle, and then you build upon those relationships to get where you're at. And so that's kind of in a nutshell where we're at as a fund, how I'm approaching it as a fund, I guess.
Yeah. And then Ryan, whenever you're ready, if you did want to share your screen, I think you can hit the present button and then just share your desktop. And then I think that should pull up over there.
Here we go. All right.
Okay. So you able to see if I think I got to see it in my system. So yeah, hit present. And then I think just do share screen. And then it should, there we go. Okay.
You got it, right?
Cool. You able to control it? Perfect.
Yeah, I'm able to control. So I put some files into Drive. And so what we're going to do is we're going to talk a little bit about fund modeling here. And along the way, I'll talk to everybody about different points of views and perspectives I have. When Joel and I first met, this guy was starting a company called Tactic, which has now been acquired by Carta, right?
Anubhav. Yeah.
So he and Carta have some very interesting tools that you can use around portfolio construction. And when we think of portfolio construction and fund models, there are a lot of things that one needs to consider and look at. You have to ask yourself, what are the required multiples that your LPs are going to be expecting of you, and what do you want to aim for? You really have to think about, what's your fund horizon? What type of fund are you? Are you an evergreen fund that has an endless horizon? Are you a 10-year fund? Are you a 12-year fund? Are you a 10-year plus 2-year, 2 1-year extensions funds? What do you want your fund size to be? This is 10 million. And then you have to start thinking about portfolio construction, but there's so much more that comes beyond your portfolio construction, right? You've got to look at what your initial investment check size is going to be. You have to think about management fees and carried interest. Are you going to have reserves? Will you have fees and expenses? Will you recycle? After you think about all those things, you come up with your actual investable capital number. So if you're a $10 million fund, it doesn't mean you have $10 million to invest. So that's one thing that always has to come to mind when you're thinking of portfolio construction. And then you start to plug in all these different figures in tools that they have over there around fees and expenses, what's implied carry, and P&L. You got to think about TVPI, POIC, and there's a number of different things you want to think about. And then you kind of ask yourself, well, in a $10 million fund, how many investments do I want to make? As an example, you might want to make 25 investments. You might want to make more than 25 investments or less than 25 investments. And that's all going to depend strictly on the models that you put together. So you can do back of the napkin scenarios where you kind of say to yourself, all right, in my fantasy team, I'm going to think about a $10 million fund. I'm going to think about a $20 million fund. I'm going to think about a $30 million fund. And when you're planning out fund construction and building out your fund, if you're building a fund that is built to last and scale over the years, fund over fund over fund, you might want to think now about what the future might look like as you grow AUM, and then how that would apply to portfolio construction, and how do you want to do it? Do you want to be a fund that takes a shadow approach and shadows existing funds, or do you want to be a fund that is a true outlier and believes before others believe and just goes in there and finds the best possible opportunities? Or do you want to be a $35 million fund that takes huge swings at bat where you're only investing in 12 companies? This is incredibly high risk because portfolio theory kind of leads us all to believe that you really need to have 20 to 25 investments to have any good opportunity for outperforming and getting like a 3x. But some of the best micro fund managers will follow like a founding investor approach, which is modeled after Sequoia or Kleiner Perkins back in the early 90s. And they'll just they're able to say, look, there's over 1,000 companies that are coming to market on a regular basis. How do you approach these opportunities? And how do you kind of say to yourself, what makes sense? What doesn't make sense? And how do we filter the junk? I mean, in these notes of mine here, I'm kind of saying to myself, there's over 100,000 startups that come to market in any given year. But from my perspective, the top 50 micro VCs have really filtered out the majority of those, and they're looking at 1,000 of them. So then you got to ask yourself, do I want to align with them, or do I just want to kind of look at opportunities that they're working towards? So these are also questions and things that your LP base are going to be wondering about you is, how do you think about portfolio construction? What type of thoughts do you put into portfolio construction, and how do you drive a fund? I mean, you can do a fund that has fund assumptions with a reserves model with 24 companies or less, or you can do a fund model that's aiming for 40 companies. And I believe a while back, ENIAC was saying that they believe the true sweet spot for a portfolio size is actually 37. Now, that kind of falls more in line with the Dave McClure 500 VC approach of taking multiple swings at bat as often as you can. And the smaller your fund is, I believe, the less reserves you want to have. That allows you to kind of aim for what I believe would be the best case scenario, which is a maximizing your portfolio size while also maximizing ownership. So kind of leaning into both fields as best as you can, not being as concerned about reserves, especially, and that's really pertaining to a fund size that's like anywhere from 2 million to 20 million, let's say, right? Because you need more swings at bat in order to have a higher probability of outsized returns for your LPs. And if you want to follow on to these companies and you're doing a construction model that's based on no reserves, then you really have to aim for getting pro rata. And that pro rata has to either come from the check size that you write, or it's going to have to come in a side letter with the founder that you can that will allow you to offer the pro rata benefits to your LPs to invest further into the fund, even though you know your fund isn't going to be able to follow on. Give your LPs that optionality to co-invest and follow on invest into these opportunities. So these are the type of things that I think about when I'm saying to myself, how do I build a portfolio model that really rocks? And I'm personally in favor of aiming high and having more swings at bat, and going out to drive those big fund size returns for the LPs. So this is kind of a look at a $20 million fund, and whether or not you're going to recycle or not, what your management fees are top down. You also have to look at your investment period. You've got to think about over what period of time do I want to invest this capital? And then you need to set a cadence and try to hit a mark if you can, if the market's allowing you to and the valuations are right and you're able to.
Hey, Ryan, I don't think I can see the actual model. I just see the Google folder.
Oh,
so maybe it's easier if you just share your entire screen. Maybe that helps.
Share this tab instead.
Yeah, there you go. I can see it now. Yep.
Oh my gosh. So this whole time, I apologize.
That's okay.
Yeah. So this is what it looks like. Sorry, everybody. I didn't realize that wasn't like that. But you want to kind of say, like, what type of assumptions do you want for a fund of, it's a $20 million fund, a $10 million fund, and so forth. And then you need to build in a lot of assumptions, and you have to try and stick to your assumptions when you're deploying the capital. You really have to stick to those assumptions as best as you can. Now, another thing that you got to think about when you're looking at modeling your fund is, are you thesis driven, or are you looking broadly across all industries? If you're thesis driven and you're concentrated and you have a focus in a core industry, I think the general rule of thumb from my perspective would be, 80 to 90% of your fund better be directly in that category of investments. But you do have room along the way, and your LPs are not going to budge on this much, to go a little bit off path, and you can find something that you think is a really great opportunity that's just a little bit off thesis, and you can go ahead and invest there. And some of the greatest fund managers of all time will tell you that in some situations, their highest net returner has been something that's been directly off thesis. So it's not a violation of the rules if you go a little bit off base for one or two of your investments, if you're a concentrated sector-focused investor. But you really do want to stay focused on that sector. And the real reason you want to stay focused on that when thinking about portfolio construction and fund construction is because you're going to have to explain to all of your LPs down the line, how did you get into deals 1 through 5? And they're going to reference check you, and they're going to want to talk to the founders. They're going to want to understand how that is before they make a commitment to your fund. And then they're going to say to themselves, is this fund manager, is this GP investing in a way that they tell me they're going to invest? So, and they're expecting the answer to be yes. So for that reason alone, you really got to stick to your thesis and your fund construction and your deployment. And you have to stick to these numbers and these cadences, so that when you go out to raise fund 2 and fund 3 and you build an enduring fund that raises AUM fund over fund for a fund that's meant to last, well, you have to have a good story to tell, and it has to really flow very well in the way you express how you came to the assumptions that you're at today. If you're starting out as a new fund manager, fund 1 is not going to be the biggest fund in the world in most instances, especially for emerging managers like myself. The fund size is going to dictate in many ways your strategy and how you put the capital to work. But at the same time, just getting the first fund off the ground is I think the biggest feat of all. So Don't be as concerned about having a 10 or $20 million fund. If you get a $1 million or a $5 million fund, you're doing better than most. And go ahead, get out there and deploy that capital, build your story, build that track record as a fund manager, not as an angel investor, and then carry that forward into going out and raising your second fund. And do not think that the institutions are going to be your customer on fund one, because in most cases they won't. But do know this, like we said earlier, it's about relationships. So be open to building relationships with institutions along the way, but just don't expect them to come into your fund. You keep them updated, provide them updates, maybe a monthly or quarterly newsletters. And if you're in town and there's an allocator that you want to meet with, let them know you plan on being in town. And if they are kind enough to respond to you and meet up for coffee or lunch, do it. If not, just don't worry about it. Just keep pushing forward and focus on the end goal, which is building an enduring fund and allocating in a way that ensures you are a good fiduciary for your LPs and you drive the greatest returns.
It would be helpful, like maybe just real quick, just kind of like the layers of messaging that you recommend for managers. I know we went through a lot of these exercises, right? But there's like the first like if we think about the stack, there's emails and then there's materials, right? So there's like obviously maybe the first reach out when you met somebody at a cocktail party, maybe you got their business card or email, and then there's probably like a cadence for a reach out or a follow up like a couple weeks later. So I don't know if there's any just kind of words of wisdom in terms of like the follow. I'm surprised we never talked about this, but like just kind of email communication and cadence. And one size doesn't fit all, but just in general, like, first reach out, second reach out, third. Do you add like more detailed materials each time, or any just learnings would be great.
Well, yeah, I think if you're following the rule book and playing by the rules, the best way to do it is you want to meet at a cocktail party, at a sporting event, at your kids' book reading. It could be anywhere. And at that point in time, it's just a simple, hey, I'm Ryan. Like, hey, what do you do for work? Well, I manage a venture capital fund. You do not say I'm raising a venture capital fund. That's a foul. You can't say that, especially if it's someone that you're meeting for the first time and you just don't know them. What you want to say is, I work in venture capital and we make these type of investments. Let's keep in touch. And then when that person decides to follow up with you again, you have to wait for them. In theory, you really need to wait for them to say, hey, can you tell me a bit more about what you do? I'm interested. And then you should be saying to them, are you a accredited investor? Is this something that is really of interest to you? And would you be willing or able to invest in an asset class like this? As soon as they answer that question and the answer is yes, then, it's free. The field is open. You can approach them however you wish. You can email them once a week. If they give you their email, you can call them. You can invite them to a dinner or a networking event, and you can build the relationship. But you never say, I'm raising a fund. Would you like to invest on the first time you meet with them? That's a pure violation of the SEC's general solicitation rules if your fund is registered as 506B. If you're registered as 506C, it's a bit of a different game. There's just a lot more hurdles that you have to overcome in accrediting whether or not that accredited status is as they tell you it is. And it's a bit of a more cumbersome task. Not everybody's doing it, but we do see people doing it, right, Joel? Like Dave McClure just announced the other day, he's raising a new fund, which is a 506C. And after he spit it out on Twitter, he felt compelled to spit another tweet out, which was a direct link to the SEC's guidelines that explain what the difference is between those two classifications. So it's sticky. It's still new, but there are ways you can do it and get very close to buying billboards, as these guys are kind of doing. JCal is also raising his fund under that general solicitation rule. So it's not a bad thing. It's just not something that's like a generally used practice currently. So you want to walk a tightrope. You want to try to follow the rules, because if you are really brazen about it and you're not following the rules, I don't think in most situations, especially under the current administration, that you're going to find yourself in trouble. However, if you did find yourself in trouble, they can claw back all of the investments that your LPs made in your fund. So ask yourself, do you want that to happen? My answer is no. So I'm going to follow the rules. So when you meet potential investors or someone that you believe might be of a high net wealth, get to know them just like you would get to know somebody else. It's like a business relationship date. And by the second or third date, that's when you should know enough in conversation to know if it's worth sending them some type of materials on your fund. I think the best way to proceed with sending materials to anybody would be to have them sign like an informal pact that's like non-binding, that just says, I'm interested in investing in your fund, and if I did so, it would be at 25,000, 50,000, 100,000, 500,000, whatever their number might be. And that there alone is telling you directly from them, yeah, I'm ready to go. I'm interested. Send me some more information. And then you're very clear, and you can send them a fund deck. But I don't think you should send anyone a fund deck unless they make it very explicitly clear to you that they are either an existing LP in other funds and they've done this before, or they're exploring it and they are an accredited investor and they want to know more.
Yeah, that makes sense. Were there any other things that you wanted to show on the spreadsheets at all?
I guess since it wasn't showing, I can open up again and show you a little bit more.
Sure.
But there isn't a whole lot more to really dive into there.
Yeah.
I think the best thing you can do as a fund manager is live inside of these Excel sheets and models and think of every possible scenario so that you learn and teach yourself along the way. And then also lean into other people in your network to help ensure that you're modeling appropriately. And then when you do actually launch a fund, you'll have, here we go. When you actually launch a fund, you'll have a back office and fund administrator that'll ensure that you get everything set up properly. So is this showing just this particular tab?
I see the 10 million tab, and then I see the other two to the right of it. So you might be able to zoom out a little bit, but this is good because you can see everything. So
can you see all of this?
Yep, I can see the 20 companies, 1.6 per quarter. So this is looking at like a 3-year. So this is a 3-year deployment cycle.
Yeah, this is saying like if you're going to do a $20 million fund, this is just back of the napkin math. Ask yourself a lot of questions and put these notes down and say, is this the type of fund I want to run? For me personally, the more I've dug into it and put these scenarios down, this is not the type of fund that I would actually run. I think the problem with this type of a fund is you're dependent on other people going in first, and you're too dependent on them being a signal as to whether or not you want to invest in the fund. For me, I think the best fund managers out there aren't waiting for that. I think the best fund managers out there are going to meet a founder, and they're going to know right away, right out of the gate, if this makes sense. If you listen to some of the people that are in the Midas list, they'll tell you that you can just tell right away after you've looked at thousands of pitch decks and met with several hundred founders time and time again. Your gut will tell you whether or not this is something you should really be exploring. What you have to do is be confident in the fund model that you've built and the relationships you've built with your LPs and how you're going to allocate that capital, so that when the iron is hot and that opportunity is in front of you, you're able to move on it fast.
Yeah, that makes sense.
But the only way you can feel really confident in doing that is spending a good amount of time thinking about fund models and where they're going to lie. And when you're building your fund model, you need to build your fund model out in a way that aligns with the target fund size that you're building. When you do a first close and you start deploying capital, it's going to depend how much capital you deploy into your initial first investments will depend on the size of the first close. Are you doing a first close on 25% or 20% of your fund target? Or are you doing a first close when you have 50% of that fund target circled? Depending on how you do that, it will do two things. One, it will trigger to all of the LPs you've been speaking about that a close is happening and they should be watching closely, especially if they're not interested in investing until after the first close, which is very common. The other thing it will do is it will signal to a very sophisticated LP whether or not they have time. Because very sophisticated LPs are looking at a number of fund managers, a number of opportunities. And if it's a thesis that they believe has legs and makes sense, they're going to put you at a higher mark of interest on their calendar. If you come in and you tell them you did a first close at 50% of your target fund size, that tells them that you're raising money, you're doing really well, and they're going to have to move fast if they want to get an allocation into this fund. Not everybody is fortunate enough to be able to be in those shoes. And if you're closing on 50%, then you're probably going to be able to write larger first checks into the first, couple of investments you make in quarter 1, 2, 3, and 4. But if you're closing on 20% of your $10 million or $5 million fund 1 target, you're not going to have as much capital deployed because you don't have 20% of $5 million to put into companies because you have setup costs, you have fund administration costs, you have operational costs. So it's going to actually net out to a bit less. And your first couple of checks won't be the top mark of your, say it's a 25K, say it's a 50K to 250K check size. Your first checks into those first 3 or 4 companies are probably going to be 50 to 75,000, something like that. They're certainly not going to be 250,000 a piece because you're not going to have that amount of capital to deploy into 3 different companies. As your fund target gets closer to being achieved and you have different closes along the line, you're going to have more capital that you can deploy and you can start to write those larger checks. But you have to know that when you're doing it. Otherwise, you'll deplete all of your resources really quick and you'll be caught between a rock and a hard place. And if the fund model that you've been pitching to your LPs is deployed in a way that is not sound, it's really going to hurt you and put you in a lot of trouble. So you really have to be aware of, you have to have strong situational awareness of what's going on around you, what type of capital you actually have to deploy and how you're going to deploy it. And you need to do it in a way that allows you to be successful and allows you to tell a strong story of growth and allocation as a good fiduciary to your LPs.
That's helpful. When you guys are thinking about follow-ons, what are some thoughts that you're hearing from maybe your peers, as far as just, how they're thinking about their follow-on strategy?
I think a lot of people, when they think about follow-on strategy, they're really trying to follow on into the winners that are meeting metrics that are aligned with industry growth. It's nice. In theory, it would be really nice to have at least 20% reserves to follow into those winners. But you might have a multitude of companies that are follow-on worthy, but you don't have enough capital to actually follow on to every one of them. So that's when you have to sit around and maybe meet with your LPAC or with your investment team and make hard decisions and say, well, they're both on a really strong trajectory. they're both meeting our goals and our objectives, but maybe we don't have the capital to, follow on into each of them. Which one are we going to do? And that's when you have to vote and come to consensus and pound on the table if you really want it to happen, and do it. And if there's other opportunities that maybe the fund can't get into, that's when you lean into your pro rata, and start going into those LPs and giving them opportunities to take that additional pro rata so that they can get the alpha that they're looking for if they want it. So you have to play both ends of the table in that situation.
Any learnings? We're actually going to be doing a session on fund audits. So just any learnings or best practices for, obviously tax season is around the corner. Most people are taking the extension. So just best practices for reporting, performance reporting, giving updates to LPs, making sure the K1s are, delivered in a timely manner, communication to LPs, really essentially the back office stuff, the less sexy stuff.
So I'm biased now as it relates to back office. I used to kind of say, well, you have a number of options, and you have a number of options, but you also have to look at those options and tie them to your fund size. If you have $100 million fund size, you really need to find a really strong tier one back office that is, doing back office for funds anywhere from 30 million to $1 billion in AUM, right? Because if you're at 100 million in AUM, there's going to be a number of LPs, a number of docs that have to go out, a lot of financial modeling and work that has to be done. And you as an individual can't do it all on yourself. You have to be able and willing to you have to be willing and able to move these functions out into the hands of other people and let them go with it. So you've got to be a good delegator of tasks. And if you have a strong partner for fund admin, you're in a much better position than if you're trying to do it on your own. We have an investment at Roadster in Decile Group, which we were a very early investor in that group, and they manage all of our back office, and we do everything through them now. And it's proven to be a really strong solution, especially for emerging managers and for some that are more established. But there are a number of options that you have to do that. I would just say, do your homework, do a lot of diligence, and before you say yes on anything, make sure that you're talking to a fund manager that has used it in the past or is currently using it, and ask them how things work. Don't just take their word for it, because in some cases there might be hidden costs that you're just not aware of or don't come up in your initial discussion before you bring on that particular fund administrator. I haven't run into this problem personally. I've just heard about it happening. So I would just caution that, just like before you make an investment, you do your diligence on the founder and the team, and whether or not their tech is their own tech, whether or not it's proprietary, if there's a moat. You want to do the same when looking at providers for your back office solutions.
Yeah, I always say, one of my favorite sayings is, when you pay less, you pay more, right? So if you get a cheap attorney, or you get a cheap doctor, or you get a cheap fund admin, in the future, you may just pay more, right? Because there's just, those harder problems are probably not solved with the cheaper solution. And we saw a lot of this with Assure, right? I mean, just kind of,
oh yeah,
I mean, they were the loss leader, and a lot of people had to eat a lot of costs, and actually, lost money because they were still on the hook to pay for all those admin fees. So I think that was a whole disaster.
Well, there's a lot of disasters around Assure, but I tell you, what was crazy about it is just like the timing of it, like the way that they announced the change and said, "Hey, it's on you." It happened it was like Thanksgiving Eve or Thanksgiving morning. Like everyone is sitting down with friends and family here in North America to this big feast, and all of a sudden, if you're a fund manager and you're relying on them for an SPV or for fund admin, and like you're screwed.
Yeah.
And like, what in the hell do I do? It was a whole nother ball of wax, like right on top of the Silicon Valley Bank fiasco. And that one was not, I don't believe, was resolved as well as the SVB fiasco was resolved. So yeah, Joel, you're right. A lot of people got caught holding the bag, and it put a lot of people into a very precarious position that they shouldn't have been in otherwise. But that's part of the challenge you run into when working with less established firms.
Yeah, no, I totally agree. Well, look, we got about 10 minutes left. I think one idea that I've wanted to kind of switch up with these conversations is just maybe talking about top level news headlines. I'm just looking at the news here. I don't see anything that really piques my interest except Doge says that it needs to know the government's most sensitive data, but can't say why. So that's just literally, I just Google news. So that's just one top line thing that maybe gets a reaction out of you. But you know, what are you kind of thinking right now in terms of just the venture market and just kind of trends that you're seeing for just managers? You've got a lot of peers, and then you're also kind of investing in computing and deep tech. So, any top level insights that you want to share or opinions?
Yeah, I think top level insights without getting political. I would say, you know, in good times and in bad times, there's one constant, and that constant is there are always a lot of unknowns and there's always instability. So I think in order to be successful, you have to maintain a positive focus, and you have to stay positive, and you have to look forward. In venture, we're not looking at today. We're meeting people who are inventing and creating for tomorrow. We're meeting them today, but they're creating it for tomorrow. And tomorrow is not a 4-year presidential term. Tomorrow is 8 to 10 years from today. So I think regardless of any market downturns, tariff talks, or anything that might be going on in the current administration and landscape we have here in North America, or anything in any international market, wherever you're at politically, just know that it's normal. These things happen all the time. There's always been unrest for the history of time. So you just got to push forward and move through it. In North America, I think venture capital in particular as an asset class is primed for growth. We have a number of VCs in the White House right now. The VP is an ex VC, and they want to see innovation drive and move forward. I think some of the challenges with the tariffs or the tariff bluffs, they're going to exist. They might not go away right away, but they're there. And you just have to find a way to look through it and keep moving forward. I do think we will see more liquidity in the markets coming up soon. That will be good for LPs. I do think LPs really need to say to themselves, do we want to invest in the herd, or should we be investing in more of these emerging managers? And I think the best time to invest in emerging managers is before they have a track record. So if you want to get in with some of the best opportunities in emerging managers, you want to invest in that fund one of theirs and get them off the ground, and make sure that new voices that are driving innovation forward and investment forward in these categories are getting the capital they need in order to deploy it efficiently and be there for the long run to build up new firms and new funds. And these smaller emerging managers have access and speed of execution that the larger firms don't. So I think you're going to see really strong returns coming out of a lot of these emerging managers. So don't look twice, look once and make a decision and invest in these emerging managers.
One news article that I'm seeing right now is I don't know if you remember Dollar Tree, but Dollar Tree is winning over high income shoppers because of the tariffs and the price hike. So that's kind of interesting. When you think about strengthening brands like Walmart, Dollar Tree, Payless, right? Those brands are possibly going to attract more people just because of the the price hikes. So I don't know what your reaction is to that, but there's also studies on just, how brands get branded as a premium brand versus like a budget brand, right? So the color red normally means it's kind of a lower priced item. Obviously red also means like emergency, but greens or blues are usually hinted to be kind of like tied to a more premium brand. But I don't know what your reaction is to that. Just kind of some of these more lower prominent, reputed brands that are known for discounter prices now getting a little more domination as a result of just kind of the macro trends.
I think with macro trends, a lot of these players will definitely see more influxes of spend. Consumer confidence is down. It's not as high as it once was. I was finally able to buy eggs at Costco 2 days ago. I haven't been able to buy eggs in the last I'd say 6 weeks at my Costco.
Yeah.
But
what do they cost? You're in Oregon, right?
Yeah, I'm in Oregon. I think it's a pack of 20. I think it's 2 dozen, so it's like 24. It was like I want to say it was $8.30.
Yeah, that's like the price of the organic. Like over here in New York. I mean, and I haven't checked the price recently because we buy stuff on Amazon. But yeah, I mean the more higher end. This is in Manhattan, right? The more higher end, they say farm raised. Who knows? But that's like just 1 dozen. They're usually around 8. So I wouldn't be surprised if they're like $15 to $20 now just for a regular pack. And this is for the standard pack of eggs, like just the regular.
Yeah, this
24.
is like double A extra large egg.
Yeah.
Yeah. So
those used to be like $2 back in the day.
Yeah,
it used to be like 99 cents
for a dozen. Yeah.
Mm-hmm.
You're dating yourself. For an 80-year-old guy, you're really dating yourself.
I know.
But I think, we'll see. The things, it's just we're living in a new world. There's new things going on. There's a lot of geopolitical unrest and challenges in the world, but those things are constant, and we just have to adjust to them and move forward with them. But I think venture as an asset class is great. I believe that venture is counter-cyclical to public markets. I also believe that great companies are founded during downturns. Look at Google in particular. Look at other companies in around that time, right after 9/11, that were founded, and others. There's really good opportunity, for growth right now, and there are huge scientific breakthroughs that are occurring in real time right in front of us around everything from AI to quantum and different data sets, and just the way people engage with one another in social media, and the way consumer brands connect, like you were speaking to earlier, right? B2C connections and brand identity, brand values, associated value. You were talking about red versus green. I think it's wild that Dollar Tree is green, and the term $1.99 or 5 and below, like that does not signal high value to me, but it's green. TJ Maxx Home Goods, they're red, but they're a bit of a higher quality product. So I think consumers are going to find deals when they can find them. I think as humans, it's in our nature to want to barter. And in American culture, it's not as natural of an instinct, unless you're into, going to garage sales and bartering. But it's become much more commonplace to want to find a deal, especially when the pennies are getting pinched, costs are going up, tariffs are up, and things of that nature. So I don't believe tariffs are will go away anytime soon. I don't think that costs will come down significantly anytime soon. I think we're kind of in it right now, and we're just going to have to weather the storm and look for ways to outsmart it as families and individuals and consumers, and put your best foot forward, and be positive, because if you're not positive, it's going to be really easy to kind of lose your breath. You don't want to do that.
Yeah. Well, this is actually a really fun exercise. I'm literally just going through headlines while I'm having this conversation. But I got one more soundbite, and I know we're literally right at time. But this just came out a couple hours ago. Amazon is testing shopping health assistance, shopping and health agent assistance as it pushes deeper into generative AI. So I just think a lot of people are going to be looking at agents as an opportunity. My only risk is there was a lot of frothiness with AI co-pilots, in the venture space. A lot of those companies got decimated. So I feel like the agent space may be, kind of a similar trend, and I think a lot of the bigger corporations, Fortune 500 incumbents, are already kind of building that natively within their systems. If you think about Zoom and all these other tools like Canva, they already have kind of like these little co-pilots and areas where you can type in a prompt. So, maybe just one sound bite on AI as you guys are, actively looking at, AI and computing deals. And then I know we get a run.
For me, I'm excited about agents and what they can do. I think you're right. I think the larger corporations are building it natively into their product offering. So when you're looking at these type of agents, I think the ones that are going to perform and do well are those that are incredibly niche, and really target a specific niche industry or opportunity, and really drill in really, really deep and do it better than anybody else, and have a lot of proprietary data sets and customers behind them that are enabling them to be the best at what they do. So that's where you really want to kind of dive deep into the agent space. We're reviewing a company right now that's doing exactly that. And the reason we're looking at them is because of how niche focused they are, as well as, the strength of the team. The team comes from a very strong industrial manufacturer that's very large on a global scale. So they have existing relationships within that particular business, and strong knowledge and know-how of how that industry they're applying their agent to works. So we think they have a high probability of success and growth with customer acquisition and a good GTM strategy. And they have a lot of proprietary tech under the hood. That's really important. There needs to be proprietary tech. We don't want them using off-the-shelf solutions to get going today and then tell us they're going to build something proprietary tomorrow. Like if they say that, it's an automatic, we're out. We want you to come into the table with something fresh and new right out of the gate.
Sure. Well, hey, Ryan, this is amazing. Good catching up. Thanks for the lecture on how to launch a fund, and thanks for doing a newscast with me, talking about trends. We got to do more of this with some other people in the private equity space.
All right. Thank you, Joel. I really appreciate it. It's great to spend some time with you and your audience today.
Likewise. Thanks. Take care. Have a good one, everybody. Bye.